Hello and thanks for watching. Over the next few minutes, I'm going to share the numerous updates, fixes, and new features that have been added to my self-storage development model since the original. Now, when I released this self-storage development model, it was an adaptation of my apartment development model. And in releasing the self-storage development model, I built a walkthrough video. However, since that release, there have been over 100 features, bug fixes, updates that have been made to the model. You can find those on the version tab. And therefore, the original walkthrough video is lacking some of these features. And so I'm going to go ahead and talk through the new features that have been added to the model and share with you how to use those features. So the first feature I want to mention is here on the Summary tab. You're going to notice now that I've enhanced the project costs by month table as well as the equity and debt cash flows table. And now I'm using a stacked column chart to visualize the uses of capital or the project costs, land costs, hard costs, soft costs, and carry costs by period. And so you'll see, for instance, the month 0, you have a big land cost amount. That's in purple. And then some small carry costs at the top of that, and that really are the initial financing costs related to this asset. On the equity and debt table, I went ahead and separated out equity and debt, equity in blue, debt in green, and then I, instead of creating a new legend here at the bottom like I had done on the project costs in the equity and debt table, I simply added the blue color and the green color in the heading. So those are really the major changes on the Summary tab. Now let's look at the numerous changes to the Underwriting tab. Now the next thing that was added is the ability to use variable income line items. We find that here in the Operating Cash Flow module. And what you'll see now, and this is a feature that we also rolled into the operating expenses, but I'll demonstrate in the other income. We have the ability for these line items that are independent of rent to be variable based on occupancy or fixed. So for instance, let's say that we have billboard income, meaning as part of the development we put a billboard up. And that billboard, whether we earn income from that billboard, is entirely independent from the occupancy percentage in our self-storage units. So we would set this to 100% fixed. And in this case, what that means is that as I go out to the right, the moment that operation begins, and in this case that's month 13, we receive 100% of the expected rent from that unit. In contrast, the RV or boat parking is 0% fixed, or in other words, 100% variable or 100% tied to the occupancy in the building. And therefore, in month 1 of operation, we're 10% occupied as a building, and therefore 10% of the potential RV boat income is earned in that period. If you are, say, 50% fixed, what that means is 50% of the income, or the expense, in the case of an expense line item, 50% is irrespective of occupancy. So in this case, we get 50% of the $30,000 per year, or in other words, $15,000 divided by 12, plus we get some variable, or in other words, 10% of the remaining 50%. And that total in this case equals $1,375 for month 1. So that allows you then to account for variability in income or expense line items. Now, expense line items are a bit more intuitive than income, right? So for instance, property tax is fixed. Insurance is fixed. But then things like, say, utilities, some of it's fixed, right? You're going to still pay utilities if you have an empty property, but your utilities rise as you have more occupancy, as more users are at the site and so forth. So you now have this ability to add variability to your income and expense line items. So the next thing that was added, and this is just an input, but it's really helpful and I wanted to point it out, and that is the input that is what percentage of lease-up income is used to pay construction interest. So by default, that's 100%, meaning if the property produces income in excess of expenses, such that there is excess income or net operating income, that amount is 100% of that amount goes to pay interest until your full debt service payment is paid during the construction period. But let's say you have a situation where your lender allows you to take home a portion of that income, say 50%. We can do that, and now you'll notice that the capitalized construction interest, or the amount of interest that accrues to the loan balance, grows, because now we're using $250,000 less of lease-up or operating income during the construction development period until you fully stabilize. That income is no longer used, and therefore your construction interest grows. But if we go back to, say, 100%, you'll see 255 is how much gets added to the construction loan balance. We could go the opposite way, say 0%, and now every dollar of construction interest due, rather than it being paid by operating income, is or accrues to the loan balance, or causes the loan balance to grow, and therefore that interest is due at the end of the loan period, rather than being partially or fully paid by some lease-up income. Now, there's a few metrics that have been added. The first is we now have a debt service coverage ratio for your permanent loan that's automatically calculated for you. There's also a stabilized year one cash-on-cash return metric that is automatically calculated for you here. And those two metrics also now are summarized on the Summary tab, and they give you some sense of what the risk and returns look like once the property stabilizes. Now, the next feature is back in the partnership level cash flow module. And there are certain situations where the GP may or may not catch up to the LP, depending on how the partnership agreement reads. And so let's imagine that the pro rata share of contributions between the LP and the GP are 90-10. But let's imagine that the LP receives 100% of all cash flow until it has hit its IRR hurdle, in this case 9%. Up until that point, the GP has been distributed nothing. And many partnership agreements will have some clause that says, okay, once the LP hits its hurdle here, before we go into the second tier, the GP has the ability to catch up to the IRR that the LP has hit at this stage. And to do that, we have this anytime there is, or anytime the LP is distributed a greater share in the preferred return tier than what it is its pro rata share of contributions, this GP catch-up toggle appears. And here we can choose, no, the GP doesn't catch up, and simply begins to receive distributions in Tier 2. And you'll notice here that when this happens, when it's no catch-up, the GP earns an IRR of 32%. When we toggle this to yes, the GP's IRR goes up to 36%. And that's because the GP now is receiving a return in that first tier. It just doesn't receive those cash flows until the LP has hit its IRR hurdle. Now, the last thing to show you is related to capital reserves. Let's go to the operating cash flow module. And you're going to now see an input called capital reserves placement. Now, in apartment buildings in the United States, oftentimes the lender will require that a capital reserve is included in the calculation of NOI. And so it becomes necessary to include the capital reserve above the NOI line. And so we now have this toggle, and in self-storage, this may or may not be the case. This is really dependent on the lender and or depending on the firm and their underwriting methodology. You can choose to place some capital reserve within the operating cash flow, or in other words, above NOI or below NOI. Now, if it's below NOI, we have this make ready costs line item. Really, it's a line item. It's the general cost to turn over a unit. And down in the capital expenditures section, you have actually a capital reserve. Now, if we do above the line, the capital reserve just simply becomes a miscellaneous reserves line. You might even just zero that out. Oops, zero that out. And then you have this capital reserve where you'll set some number, maybe $25 per unit, like so. And that's our capital reserve. But nonetheless, there now is this ability to choose where you add your capital reserve. Now, those are all the new features that have been added to the model since it was originally released. Now, behind the scenes, there have been numerous updates, fixes, optimizations. One example is we have this recalculate macro, right? So anytime that the underwriting changes such that the amount of interest that it needs to be calculated changes, you'll see it say if we come down here, let's set our interest rate to a fixed rate, and let's raise the rate to 5.5%. As soon as we do that, this click to recalculate button appears. Now, if you're curious how that happens, is down here, I have a check. And I ask, okay, do we need to recalculate the loan? And we know we need to recalculate the loan if the actual loan to cost, and we'll find that here, 65.2% does not equal the target or the inputted loan to cost assumption. And so what needs to happen, anytime those don't equal one another, the model recognizes that, turns on this click to recalculate button, and then you go ahead and click it, and then in the behind the scenes, the model is iteratively changing the equity amount here until the construction debt is equal to 65% of cost. Or in other words, or equal to the input, in this case, 65% of cost. So I could change this, say, to 60. You'll see this doesn't change. This is still 60 and 60. This is now 65. Oh, I'm sorry, this is 65. We need it to be 60. You click here. This will now iteratively change the equity until this becomes 60. Now, the reason I mention that is I've dramatically updated or changed the macro, optimized this macro to make it faster, and also to recognize one situation where the macro will break. And so, so that the macro doesn't break, I added some logic. And the reason the macro will break is if you have embedded a circular reference into your model. So for instance, let's say we had this input here, financing fees, and we made that equal to the construction debt. That creates a circular reference in our model, right? And that circular reference will make it so that the macro will not run. But before, you wouldn't have known that. And so now, say I click this, you'll see it appears you have a circular reference in your workbook. This recalculate feature does not work when the circular references are present. Then it asks you to break the circular reference. And in this case, I'd come back to that value where I set the circular reference and remove it. And as soon as I remove it, the recalculate button or macro will work again. So those are the changes that have happened since this model was originally released. If you have any questions about any of these changes or the model in general, don't hesitate to reach out. And otherwise, thanks for your time.